I have spent most of my life learning one simple lesson about markets. Price is not set by who is smartest. Price is set by who is forced. That is the first thing I want you to understand about gold right now, because if you miss that, nothing else you are seeing will make sense. A lot of people look at a falling gold price in the middle of a war and conclude that gold has failed. I look at the same tape and ask a different question: who just lost the right to wait? That question has made me a lot more money over the years than staring at headlines or worshiping any asset class ever could. When a business falls in price, I do not start with the quote. I start with the reason. When a stock is down, I want to know whether the economics got worse, whether the balance sheet got weaker, whether the competitive position cracked, or whether somebody simply had to sell. Those are very different worlds. The market likes to price them as if they were the same thing. They are not. Gold is the same. What is happening in the gold market right now is not a normal opinion change. It is not some clean, rational committee meeting where central bankers sat around a polished table, looked at the long-term case for gold, and decided they no longer wanted it. What is happening is much uglier. Countries that spent years accumulating gold as monetary insurance are now being pushed into pawning that insurance because the war, the oil shock, the dollar shortage, and the plumbing of the reserve system are hitting them all at once. That is not a philosophical shift. That is a margin call. I want to be careful with that phrase because people hear margin call and think of some over-leveraged day trader blowing up in his brokerage account. But the principle is identical. A margin call is what happens when you have a valuable asset. You still believe in the asset. You may even need the asset, but you are forced to part with it because a more immediate obligation has grabbed you by the throat. That is the gold market today. This is why I think so many investors are misreading the whole episode. They are treating emergency supply as if it were strategic rejection. They are confusing a fire sale with a change in religion. They are looking at the man carrying furniture out of a burning house and assuming he must no longer like the furniture. That is foolish. A great many fortunes are lost by people who cannot distinguish between voluntary selling and compelled selling. I have learned that when the strongest hands in a market start behaving like weak hands, you do not automatically conclude the asset is broken. You first ask whether the hand is weak at all or whether the owner has simply run out of oxygen. Gold did not rise over the last few years because retail investors suddenly became brilliant. It rose because the most serious buyers in the world, central banks, sovereign institutions, governments with long memories and deep suspicion, spent years quietly moving part of their reserves out of the paper promises of other nations and into a reserve asset with no counterparty. That was the real bull market. The public likes stories about inflation, chart patterns, and television slogans. Institutions care about something colder than that. They care about what can be frozen, what can be sanctioned, what can be diluted, what can be printed, and what cannot. The day the United States and its allies froze Russia's foreign reserves, a great many finance ministries around the world learned a lesson they should have known already. A reserve asset held inside another man's legal system is not fully yours. A number on a screen can be neutral for 10 years and political on the 11th. A reserve that can be frozen by decree is not the same as a reserve that you can hold in a vault and touch. That was the sanction memory. It changed the psychology of official buyers. Gold did not become useful in that moment. It became visibly necessary. That is one of the mechanisms I want you to hold in your mind because it has not gone away. I call it the sanction memory when a system reveals that access can be revoked. The search for assets outside the system accelerates. Gold sits outside the permission structure in a way treasury paper never can. It cannot be printed by somebody else's parliament. It cannot be sanctioned into non-existence. It does not depend on somebody else honoring a promise next Tuesday morning. That is why central banks bought. Not because they were superstitious, not because they were nostalgic, because they understood the rules of the game had changed. Now comes the part most people still do not understand. An asset can be strategically desirable and tactically dumped at the same time. That sounds contradictory until you have lived through enough crises. I have seen good businesses sold because banks pulled credit lines. I have seen excellent land sold because the owner needed cash before harvest. I have seen solid insurance float treated like a treasure in one season and collateral in the next. Gold can be insurance in one quarter and pawn collateral in the next. The underlying reason for holding it can remain intact while the immediate need for dollars overwhelms it. That is exactly the setup we are in. The first mechanism driving this reset is what I call the energy squeeze. If you run a country that imports most of its oil and gas, and a war suddenly sends your energy bill sharply higher, your problem is not there, it is immediate. Energy contracts do not care about your speeches. They are priced in dollars. Your refinery does not want your patriotism. It wants payment. Your electricity grid does not run on historical conviction. It runs on settlement. Turkey is the cleanest example. A country can spend years trying to diversify away from dollar dependence, years building gold reserves, years talking about sovereignty, but if its energy bill is priced in dollars and war sends that bill soaring while its currency falls, the central bank is shoved into a corner. That corner has only three exits. Let the currency collapse, burn through dollar reserves, sell gold. The first choice risks inflation, panic, and political instability. The second choice has a hard limit, so they reach for the third. That is not because gold stopped being important, it is because they need dollars. Now, if you own a farm and you have to sell breeding cattle to buy seed after a flood, it does not mean cattle are a bad asset. It means the flood came first. That is the energy squeeze. Rising oil prices create immediate dollar demand in countries that cannot print dollars. Their local currencies do not settle those import contracts. Their speeches do not settle those contracts. Gold can be converted into the thing that will. The investor who does not understand this watches gold fall and says the thesis is dead. The investor who does understand it says no, the thesis has become temporarily more painful. Pain and invalidation are not the same. The second mechanism is even more important because it drags entire regions into the same trap. I call it the peg defense loop. A currency peg looks stable from the outside because people focus on the fixed exchange rate. They see calm water. What they do not see is the plumbing beneath it. If your currency is linked to the dollar, your central bank must be able to supply dollars when pressure comes. That arrangement works beautifully when export dollars keep flowing in and confidence stays in place. It looks permanent right up until it looks fragile. Now picture the Gulf. Their system works because they export hydrocarbons, collect dollars, and use those dollars to maintain confidence in the peg. In normal times, the bathtub keeps refilling. The inflow covers the outflow, but war changes the rhythm. If shipping is disrupted, if tanker routes are constrained, if regional risk rises, if food and military imports rise, while confidence leaks out through capital flight, you can get a terrible combination. Fewer dollars in, more dollars out. The bathtub drains. That is when the peg defense loop begins. The central bank has to choose between letting the currency wobble, which can become political suicide in a system built on stability, or finding more dollars. Again, it reaches for collateral. Gold becomes a shock absorber. The public thinks the country is selling treasure. The central bank thinks it is buying time, That distinction matters. Once you understand the peg defense loop, you stop treating rumored or quiet gold sales as random bearish data points. You see them as symptoms of a much larger liquidity problem. The gold is not the disease. The gold is the collateral being monetized to survive the disease. This is why I say the market is being reset by forced sellers, not persuaded sellers. A persuaded seller changes his worldview. A forced seller changes his calendar. He still wants the asset. He just cannot afford to own it this week. That difference is everything. The third mechanism is what I call the war chest drain. Wars do not merely destroy things. They reorder budgets, funding channels, reserve priorities, and survival math. They pull future spending into the present. They turn strategic assets into budget sources. If a nation is financing military operations, defense expansion, or emergency external payments, assets that looked untouchable in peacetime suddenly become available for monetization. Russia is the obvious case, a large producer of gold, a state under sanction pressure, a system building alternative settlement channels, and a government funding wartime obligations all at once. That combination changes the role of gold in the short run. Not because Russia has stopped understanding the value of gold, but because wartime finance does not care what asset class your long-term strategist prefers. If you have a war to fund, you fund it. If you have an external restriction looming, you move before the window shuts. That is why pre-deadline liquidation matters so much. If holders know export rules are tightening, they may sell before the gate closes. That adds supply now, which weighs on price now. Even though the same export restriction may reduce international supply later. This is the part that confuses people. They think one event must point in one direction. Real markets are not that polite. A rule can create short-term selling and longer-term scarcity at the same time. That is why amateurs get whipsawed. They insist on one-dimensional stories in a world made of stacked time horizons. My experience has been that if you want to survive in markets, you must separate what happens now from what becomes true later. The war chest drain is short-term pressure. The structural move away from fragile reserve dependence is a longer-term force. Both can be true on the same day. The fourth mechanism is the one most people never notice until it is over. I call it the forced floor. Every major reset has a point where an asset is no longer being sold by people making a careful choice. It is being sold by the last group that still has something left to liquidate. That is important because forced supply, by definition, is finite. A country cannot sell more gold than it owns. A central bank can only monetize so much collateral before the collateral itself becomes scarce or politically sensitive. An emergency can keep going for a while, but not forever. A distressed seller does not create infinite supply. He creates aggressive supply with a visible ceiling. This is one reason I have never liked dramatic language about any falling asset unless the speaker can identify the size and durability of the seller. If you tell me the seller has unlimited balance sheet and endless motive, I listen one way. If you tell me the seller is meeting obligations, burning collateral, and obviously finite, I listen another way. Forced floors are not easy to call with precision, but they are easy to understand in principle. When the market is being fed by emergency liquidations, the eventual exhaustion of those liquidations becomes part of the bull case, not part of the bear case. That does not mean the price turns tomorrow morning. It means the reset is a process of clearing. Weak hands clear, compelled hands clear. Then price discovers what strategic buyers are willing to pay after the panic inventory has moved. I have watched this pattern enough times to know that the public usually gets interested right in the middle of it. They buy the top because the story feels safe. Then they get shaken out during the reset because the story feels broken. Then they return at a much higher price once the institutions have done the patient work. That is not intelligence. That is theater. I have never wanted to be part of that audience. Now let me tell you why I do not believe this reset kills the long-term gold case. The simplest answer is that none of the reasons central banks wanted gold have been repaired. The sanction memory still exists. The geopolitical fragmentation still exists. The desire to diversify away from a reserve system that can be weaponized still exists. The extraordinary fiscal reality of the developed world still exists. And perhaps most importantly, the mathematics of sovereign debt still exists. The public talks about gold as if it were merely a reaction to inflation headlines. That is far too shallow. Gold is a response to the credibility of the unit in which everything else is priced. If the developed world were running modest debts, stable budgets, disciplined money, and politically neutral reserve systems, gold would be a different proposition. That is not the world we inhabit. The United States debt burden has become so large that interest costs themselves are now a major fiscal force. Countries all over the world are watching this. They may trust the dollar more than their own currency, but that is not the same as trusting it forever in the old way, when trust changes from absolute to relative, reserve behavior changes with it. Gold benefits from that shift, not every day, not in a straight line, but structurally. This is why I keep returning to the distinction between temporary dollar hunger and permanent reserve logic. A country under acute pressure may need dollars urgently. That need can force gold sales. But the same country can still conclude, once the pressure passes, that gold belongs in its reserve mix precisely because the crisis reminded it how fragile access to other assets can be. In plain English, a country may sell gold in a dollar emergency and buy gold later for the next dollar emergency. That is not hypocrisy. That is reserve management. The investor who can grasp that will stop making childish all or nothing judgments. He will stop saying, if gold is good, why is it falling? He will ask a better question. Is this decline coming from a broken thesis or a broken cash flow? I would much rather own an asset temporarily pressured by broken cash flows than an asset temporarily elevated by a broken narrative. Narratives can last a long time, but they do not settle invoices. Now I want to take you one level deeper, because this is the point where I think a serious investor needs to change identity. Most people in metals behave like price tourists. They visit the chart. They react to the latest move. They look for confirmation that the last candle agrees with their mood. That is not investing. That is emotional weather watching. The shift I want for you is from price tourist to liquidity reader. A liquidity reader does not start with gold. He starts with the pressures acting on the owners of gold. He asks who needs dollars. He asks who is defending a currency. He asks who is funding war. He asks who is facing an export cutoff. He asks whether buyers paused because the thesis changed or because timing did. Once you think that way, the market becomes much clearer. You stop being hypnotized by the quote. You begin understanding the hand behind the quote, that identity shift matters because it changes behavior. A price tourist wants excitement. A liquidity reader wants asymmetry. A price tourist buys stories. A liquidity reader buys forced mispricing. A price tourist panics when the move contradicts the headline. A liquidity reader expects dislocation whenever collateral is being monetized under pressure. This is the kind of shift that separates a man who gets used by markets from a man who uses them. Now, I am not telling you to worship gold. I have never believed in worshiping any asset. My rule has always been simpler. Know what the thing is for. Know what can hurt it. Know who owns it. Know who might have to sell it. And know whether the reason it exists becomes stronger or weaker after the pain. That framework has kept me out of a lot of expensive stupidity. Gold is not a productive business. It does not compound the way a wonderful company does, but that does not make it useless. It makes it different. Its job is not to build an operating empire. Its job is to stand outside a system and preserve purchasing power when confidence in that system starts wobbling. When you understand the role correctly, you stop demanding the wrong behavior from it. You stop saying, if gold is insurance, why is it volatile? Insurance can be repriced in a panic too, especially if the insurer is being sold by people trying to raise cash. That is exactly why the reset matters. Let me tell you how I think about the road ahead. I think in 3 clocks. The first clock is the liquidation clock. This is where we are when emergency sellers are still active. The tape is heavy. Rumors matter more than they should. Confirmed sales weigh on sentiment. Official buyers pause, trim, or stand aside. Every new deterioration in oil routes, energy bills, currency weakness, or capital flight extends the clock. During the liquidation clock, the price can do things that offend your sense of narrative logic. You can have war and falling gold. You can have long-term bullish arguments and ugly short-term charts. You can have institutional conviction and visible distribution at the same time. That is normal. The second clock is the stabilization clock. This begins when the immediate pressures stop intensifying. Oil does not have to collapse. It merely has to stop acting like a fresh tax on vulnerable importers. Currencies under attack do not need to become strong. They need to stop breaking new lows every few days. War finance does not need to disappear. It needs to become funded through channels other than emergency reserve liquidation. Once those pressures stabilize, the need to sell gold for dollars begins to fade. This is the phase where the public often remains distrustful, because the recent damage is still vivid. That is useful. I like markets where the memory of pain lingers after the actual pressure begins to ease. Those are often the moments when the asymmetry gets more interesting. Then comes the third clock. I call it the re-entry clock. This is when the strategic buyers that never abandoned the logic of gold begin behaving like themselves again. Not all at once, not with a trumpet, quietly, methodically. The same way they bought before the reset. That is the part many people are going to miss, because the market rarely sends a polite engraved invitation. The price starts rising off a base built during the ugly period. Analysts invent a story after the fact. Retail arrives late and calls it confirmation. It is not confirmation, it is recognition. Recognition always comes after the money has already moved. This is true in stocks. It is true in currencies. It is true in commodities. It is true in life. By the time a thing feels obvious, the easy money has already been made by people willing to sit with temporary discomfort while everyone else demanded emotional certainty. That brings me to the practical protocol. I do not like ending a discussion at the level of philosophy alone. A thesis without a protocol is a story people tell themselves while doing nothing or doing the wrong thing. My protocol here is straightforward. First, separate structural belief from tactical pressure. If you think gold's long-term role has strengthened because sovereign reserve trust has weakened, do not let short. Term force selling bully you into pretending the structural case vanished. Structure and timing are different categories. Mixing them is how people sell value and buy relief. Second, track the pressure gauges, not the noise. Watch the countries most exposed to higher energy bills. Watch the currencies under stress. Watch the visible reserve sellers. Watch the policy deadlines that could accelerate liquidation before later tightening supply. Watch shipping disruption and oil stability. If the underlying pressure on dollar demand remains intense, forced selling can last longer than you want. Patience matters more than prophecy. Third, remember that the best opportunities are born from unwilling sellers, not enthusiastic sellers. I have rarely made my best purchases when everybody agreed with me. I have made them when I could identify a seller whose problem was immediate and finite. That is what you should be looking for here. Not whether the chart flatters your ego today, whether the seller in front of you is trapped by a short-term obligation that cannot define the long-term value of the asset being sold. Fourth, do not confuse collateral with conviction. A country selling gold to defend a currency is not confessing that gold is useless. A holder selling before an export restriction is not confessing that gold has no future. A reserve manager pausing purchases in the middle of a war is not confessing that the reserve logic of the world has healed. People do things under pressure that tell you more about the pressure than about the asset. Keep your own balance sheet strong enough that you are never forced to imitate the distressed seller. This may be the most important rule of all. The entire edge in studying forced liquidation comes from not becoming one of the forced liquidators yourself. If you run your life on borrowed breath, you will always be selling into somebody else's opportunity. I have no interest in that position for myself, and I would not recommend it for you. Now let me speak plainly about the temptation that ruins most people in a reset. They want the market to remove all emotional discomfort before they act. They want the war to calm down, the currencies to stabilize, the official buying to resume, the chart to recover, and the media to declare the danger over. What they are really asking for is certainty. Markets do not sell certainty cheaply. Certainty is the most expensive input in finance. By the time the picture is clean enough for the emotional part of your brain to relax, the repricing is usually well underway. This does not mean you should be reckless. It means you must stop demanding impossible levels of emotional safety before doing sensible things. I have never needed complete comfort to make a good decision. I have needed a favorable gap between what something is worth and what panic is forcing people to accept for it. That is a very different standard. I also want to warn you against another error. Do not turn a reset into a religion. Some people discover a structural thesis and then lose all discipline. They become incapable of updating any shorter-term risk. They say the words long-term as if that exempts them from understanding cash flow stress, timing pressure, and seller exhaustion. It does not. A long-term thesis can be right and still hurt badly in the short term. A short-term reset can be real and still leave the long-term thesis stronger. Mature investing requires you to hold both truths without acting like a child who can only remember one sentence at a time. That is what I am asking of you here. Become more precise, become less theatrical. See the reset for what it is. Not a verdict, a clearing. The more I study major markets, the more I come back to one basic truth. Assets do not move cleanly from one equilibrium to another. They move through stress, through imbalance, through forced hands, through collateral damage. Gold is going through that now. The public sees contradiction. I see mechanism. The public sees a failing story. I see a sovereign margin call. The public sees weakness. I see valuable collateral being dumped by entities that still need the collateral but need dollars more. Those are not the same interpretation, and they do not lead to the same behavior. Let me bring it back to a very simple image. Imagine a family that spent 10 years building a reserve fund. They did not build it because they hated their future. They built it because they respected uncertainty. Then a medical emergency hits, an income shock arrives, and suddenly they start drawing down that reserve. Would you say the reserve fund was a mistake because it went down during the emergency? Of course not. You would say the emergency proved why the reserve existed. That is gold for the sovereign world. The fact that it is being used under pressure does not disprove its role. It proves the role was real enough that when the crisis came, it was the thing they reached for. That is why I cannot look at forced official selling and conclude the strategic logic has evaporated. If anything, I conclude the system just gave everyone another live demonstration of why collateral outside the paper promise structure matters. That brings us to the final choice, because every important financial moment eventually becomes a character test. You can watch this reset like a spectator, confusing pain with invalidation, waiting for other people to tell you when the danger is over, and then paying a much higher price for emotional comfort. Or you can start thinking like a serious capital allocator. You can study the pressure. You can watch the forced hands. You can separate emergency dollar hunger from long-term reserve logic. You can stop asking whether the market feels good and start asking whether the seller in front of you is temporary. That is the test. Not whether you can predict the exact bottom. Not whether you can tell a heroic story about yourself on social media. Whether you can recognize a margin call when it is happening to someone else and refuse to let their emergency become your confusion. I have never believed money is made by shouting louder than the crowd. It is made by seeing what the crowd is misclassifying. Right now, the crowd is misclassifying forced liquidation as strategic surrender. I think that is a serious mistake. The countries selling gold today are not teaching you that gold failed. They are teaching you that the world is short of trusted collateral, short of dollars in the wrong places, and still desperate for reserve assets that cannot be turned off by another nation's politics. Those lessons will outlast this war. They will outlast this reset, and they will matter long after the last emergency seller has run out of bars to move. When that day comes, the question will not be whether the reset was obvious in hindsight. It always will be. The question will be whether you had the nerve to read it correctly while it was still uncomfortable. That is where fortunes usually separate. Not at the moment of celebration, at the moment when valuable things are being sold by people who no longer have the luxury of choice. That is the market I believe we are in. And if you can keep that straight, if you can remember that a forced seller does not get the final vote on long-term value, you will already be thinking far more clearly than most people looking at gold today.